Welcome back to our special MPC broadcast. Well, joining us now to unpack the decision, the MPC's decision, I have independent analyst John Loos in studio with me, and Mpho Molopyane. She's Chief Economist at AlexForbes, just to take us through their thoughts. Perhaps, Mpho, I can start with you, ladies first for now. The governor has just said or described the decision that was taken to keep rates unchanged as prudent. He says that the MPC is prudent because he was challenged that perhaps they should have increased rates, because we know that come next week we're going to be hit by an almighty increase in fuel prices, and people of your ilk are talking about the possibility of inflation at 4.5% to 5% in the month of April and May if this continues. What are your thoughts? Do you think it was a prudent decision to, hold tight for now and see what happens?
I think it was a prudent decision. I think it was largely expected. I mean, the market consensus has been that the SAB is likely to be on hold. It's a prudent decision given that there's a lot of uncertainty around the Middle East situation. I mean, I think right up until last week, Friday, the consensus in the market was that this is likely to be short-lived, but it is proving likely that it's likely to be more protected than initially feared. And given that level of uncertainty that the global economy faces, a lot of central banks have taken the decision to be to remain on hold. They've also shied away from giving forward guidance, just given that we don't know how long this conflict is going to continue. But I think even more uncertain, that uncertainty is now filtering through, will oil flows continue to flow even after the war has ended, right? So it's a lot of uncertainty. It makes sense for the SAB to be on hold until they get more information to try and sift through the data. What was also quite interesting, which is an approach that we ourselves have taken, is to embark on scenario analysis. This will, help us to navigate the environment a lot quicker. So the SAB has also done their own scenario analysis, and I think that's their way of trying to provide forward guidance, right? They did indicate that in some of the scenarios that they ran, if this current situation continues, inflation would be higher, which would actually require a tightening of monetary policy, right? And that's the environment that we are now in. We've shifted from an environment where we were expecting interest rate cuts to now essentially expecting that if this situation is quickly resolved, then we're unlikely to get any further cuts, but it could actually evolve into a situation where interest rate tightening is actually back on the table now. So quite uncertain, prudent to stay on hold, as we've seen with many other global central banks this week.
So, John, let's touch on the scenarios that Mpho is referring to, that the Reserve Bank governor talked about. He said that if this situation were to continue as it is for the next couple of months, then we're likely to see at least one interest rate hike. And if it goes on for longer, there could be multiple interest rate hikes. He's basically warning us that come May the 28th, they are going to increase interest rates, because even if the war were to stop tomorrow, presumably we're going to have to deal with the impacts and effects of the fact that oil has been running at such a high price for the vast majority of the month of March. And even then, we know that capacity has been wiped out because, of course, in the conflict, capacity has actually been impacted and is going to have to be rebuilt over a number of years. So presumably that means that we are going to see an increase soon.
I wouldn't draw that conclusion, but certainly I think if we were here in 2 months' time with oil at the May MPC meeting with oil still above $100 a barrel, then I think the interest rate hike that's on the cards. But if hypothetically, let's say there was a de-escalation in the next few days and oil prices dropped quickly back to $70 a barrel, with market expecting peace and the Straits of Hormuz to be opened again, which would obviously impact on fertilizer and gas prices too, then I think there's a chance that the Reserve Bank could say, okay, let's wait it out. Let's keep rates on hold. I don't interpret it as a rate hike is a given, but But yes, they did the assumption that another 2 months of $100 a barrel, and you've got CPI inflation going to above 4% and only coming back to the target next year. Well, then I think it's possible. So I think it's very important to see where we are in May. If it de-escalates very soon, and I don't think there's any way of telling. There's rumoured negotiations. We're not quite sure if they're happening or not. But I think there's every incentive for the US to get oil prices under control, because they've got a midterm election in later this year, and cost of living has been a serious election campaign issue in recent elections. So there is every incentive. So, but yeah.
Let's wait and see. Thanks for staying with us as we unpack the MPC's decision to keep interest rates unchanged. I'm joined in studio by independent analyst John Loos and Mpho Molopyane. She's a chief economist at AlexForbes. She's there with us virtually. John, let me ask you, of course, we've tried to speculate what the Reserve Bank's next move may be. And of course, that's an impossible answer because, like you said, there's so many moving parts. But I think what viewers are very interested to know, what are your thoughts and feelings around, given your analysis of the latest Central Energy Fund numbers and so on, what are we going to be paying, do you think, at the pumps come Wednesday in terms of petrol and diesel? And another layered question there is, what sort of impact do you think, or what kind of shock do you think this is going to have on the local economy?
Well, it looks like from the Central Energy Fund under recovery numbers, the latest, that petrol prices could be high 5 rands up, and on the preview on March's price, and then diesel seems to be nearer to 10 rand. That's quite extreme. I think the first port of call is, well, it's a direct impact on transport costs, obviously. So non-essential transport trips can be reduced. Very difficult to reduce commuting. But in certain instances, in the case of office workers, I think there might be some increase in more employee flexibility, locational flexibility. Work from home to a greater extent can cushion the blow for some. Obviously, some jobs just you can't do that. So that's the first port of call. But then there's a lot of, if you're spending more on fuel, it does eat into your disposable income available for other stuff. So the luxury goods, they do worse. That's not just jewelry, and it can also be luxury foods. So you scale down on luxury goods. There's a lot of non-essential items that you don't need, maybe luxury or not, but non-essential type of spending. And then there's postponable spending as well. You know, that's your car that you wanted to replace, but it can still drive for longer, or your TV or whatever it might be. So I think they're durable and maybe semi-durable consumer goods, clothing, footwear, household appliances and so on. A lot of those things can be put on hold. And I think that's where you start to see the slowdown most noticeably in consumers, or slowdown in growth at least, in those items of consumer spending.
So Mpho, the governor really didn't speak too much about growth, except to say that he didn't really see that much of a change in terms of their prior expectations. But if this does go on for a while, what is this going to mean for economic growth and, the higher expectations that the likes of National Treasury had put on the table, 1.6% for this year?
Yeah, I mean, I think this Middle East situation really muddies the water, and it's actually quite multi-layered if you think about it. And I'd just like to take a moment to just peel some of the layers. So firstly, we know that, it's likely to be inflationary, given that fuel prices are going to increase. It could also filter through to other prices. I think that's what the governor talked about, that you could see secondary effects. And as John has also indicated, that then starts to eat into overall consumption, because consumers have to, take money away from other items in order to spend on fuel, right? Now, the thing is, that's what we've largely concentrated on now. But if you think about it, this inflationary shock, this supply shock, could actually turn into a demand shock. Yes, initially, demand is quite inelastic from a fuel perspective, so which means that it's very difficult to cut on fuel consumption. But there are things that consumers can start doing and governments can start doing. So the first thing is that National Treasury could also, make an announcement to shield consumers from this increase as we saw in 2022, which means that the inflationary impact would also be less, which means that then also translate into the monetary policy transmission mechanism. It's a less inflationary environment. Then the SARB does not necessarily have to tighten monetary policy. So then the impact on inflation and on growth is a lot less, right, in that scenario. But you then also get a consumption and growth impact. The other side of it as well is that we've had the IEA coming out last week also announcing that actually, this is quite a massive supply shock that we've actually faced in history. And they, also announced certain measures that governments can take to try and shield consumers from this shock. And some of the things that they talked about was, working from home, shifting to public transport, alternating the number of days that certain industries are actually on the road, also looking for alternative sources of cooking gas. So when you then start to look at it from that perspective, is that actually this could be a massive demand shock that the global economy is facing. Some research in some papers by the Dallas Fed actually shows that if this goes on for 3 months to 3 quarters, then the global economy is likely facing a recession, which is a much dire situation. And similarly for South Africa, the 2% growth that we were beginning to talk about for 2028 now becomes less unlikely. Yeah. Now, that then has an implication for the fiscus, right? So I talked about that depending on what government does, if they decide to shield the consumer from higher fuel prices, that then eats into revenue that they were projecting. But then there's also another double whammy, which they have to face now, that it's a lower growth environment. So then you get to see this deterioration in the fiscal outlook just when we were beginning to believe that debt stabilization is possible.
Yeah.
Now, let me throw a third spanner in the works. Sorry. The fiscal situation does not necessarily have to deteriorate depending on what happens to other commodity prices that South Africa currently produces and sells to the global economy. So like, for instance, if coal prices increase, continue to increase and do well, if the global economy begins to worry about recession, we're likely to see that support for gold prices also coming back on, right? So there could be offsetting factors from a fiscal perspective, similarly to what we saw in 2022, actually. So yeah. It's very mixed, but I think, an answer at the moment is that the Middle East situation muddies the water. Definitely that Goldilocks environment we were talking about at the beginning of the year is now, highly unlikely the longer this conflict continues.
All right. Let me now ask John a question. John, one of the things that we talk about oil all the time, but the less conversation being had is that around fertilizer and even things like pharmaceuticals. When it comes to fertilizer, what are your concern levels around how that filters through to the agricultural sector? Because that will mean, of course, a higher input cost. And what sort of impact do you think this current crisis is going to have on food prices in the short term?
Yeah, I mean, the best I can do is flag fertilizer prices as a risk. The food prices are dependent on local weather patterns and all sorts of, one needs an agriculture expert to talk about that. But it is a risk, and again, it depends on for how long the Straits of Hormuz are disrupted, because a big part of the world's fertilizer gets produced in those Gulf states and has to be transported through the straits. So that's an important one. And then, of course, diesel is a big input into agricultural production too. So there's a potential double whammy there too. Now, if one looks at who gets impacted, with direct petrol price increases, it's more the higher income groups. They're more private transport intensive and they're more transport intensive in general. So they feel the initial knock at the pumps, more so than lower income people who are more dependent on less cyclical public transport, and they're less transport intensive. It's the other way around for food prices, and therein lies a potential concern, is that if you look at the CPI baskets by income group or by expenditure group, similar thing, as you go down the income ladder to the lower income groups, there's a much higher weighting of food expenditure in their basket of goods. So that's the problem in South Africa, in a sort of a lower middle income country, I think we call ourselves. A lot of poor people. That food price potential impact would hit far harder on the lower income groups.
Mpho, just in terms of meat prices, we've heard about the massive drive to get cattle vaccinated. Do you think that we're going to have a situation where meat prices at least come down, notwithstanding, of course, the higher input costs coming from fuel and the like?
I mean, I think when we track monthly meat prices and weekly prices as well, we have begun to see some easing pressures there, and hence the expectation has been that meat prices are likely to come down. When we look at the broader inflation basket, actually, the two largest items there, it is meat prices as well as grain prices, right? So to what John was saying is that, once you get an increase in fertilizer prices, that feeds into, your production cost into the agriculture sector. You also then have another cost that you have to fare with, which is higher diesel prices. We also know that, some grains to some level are also transported through the Strait of Hormuz. And while we may have enough grain supply in the country, once we start to see international prices go up, that also does tend to affect South Africa as well, although with a bit of a lag, right? So there's definitely that concern that food prices could begin to pick up. The other thing that we also have to contend with is that actually grains are also an input cost into meat prices, right? So like if you think about feeding cost, which also tends to be grains, right? So we have this multiple cost pressures actually likely to be building up. Likely to hit the consumer quite severely, and unfortunately.
Thank you very much, John. I just wanted, as we come to the end of our discussion, just to get your last thoughts around this, because there's so many moving parts and maybe there are areas that I haven't touched. What are your last thoughts that you'd like to share?
Well, I think this is a unique crisis because of the Strait of Hormuz. That's what they call a serious choke point for shipping, or potential choke point. The geography of this conflict it makes it a potentially major crisis. But I do think there's every incentive for the US, given elections soon, to resolve this. So I don't think it's a fait accompli that we go into this prolonged period of high energy prices and fertilizer prices, I think it's too early to talk about interest rate hiking. But what's too early? Well, I think in 2 months' time, if we're still in this situation, then I think interest rate hiking may well start.
Mpho, you have about a minute to respond. What are your closing comments that you'd like to make around these issues that we've discussed?
Yeah, I mean, I think it's a highly uncertain environment, but it's looking less and less likely that this war is going to be resolved by the end of this month. We already have a buildup of army and military personnel that the US is currently deploying. So that really worries us. And we think that we could be in this situation for quite a sustained period. So I think it's very important that we start planning around that situation.
Thank you so much. That was Mpho Molopyane, Chief Economist at AlexForbes, and John Loos, he's an independent economist, in studio with me. The geopolitical environment, very, very tricky indeed. And to add to the mix, we have just recently heard that France has disinvited President Ramaphosa to the G7 meeting due to an insistence by President Donald Trump that he would not attend if President Ramaphosa attended.